Welcome to the monthly roundup from Kepler Trust Intelligence, where my colleague Ryan and I will be taking a whistle-stop tour through all the news and reviews in the investment trust world over the month of October. So as per usual, Ryan, we kick off with the news, but we are starting this edition with some high-level commentary on the impact of the budget on the investment trust universe.
Yes, that's right, Joe. We normally try and stick with trust-specific news in this part of the show. However, the news cycle in October was full of speculation over the first budget under the new Labour government. This has been covered at length by much larger media outlets than ourselves, but we wanted to touch on a couple of key policy changes that really affect some parts of the investment trust universe. These primarily were changes to the business property relief, BPR, on inheritance tax, and also the changes to the capital gains tax, CGT. Both of these had particular implications for trusts operating in the UK equities, especially UK smaller companies. Now, under the previous regime, investors in certain shares listed on the FTSE AIM index could pass on these assets after death without attracting inheritance tax due to the business property relief. There were concerns that this would be scrapped entirely, which had been weighing on the index. The market from around the time of the election to the budget was down around 6%. However, in the budget, it was announced that the relief would be reduced to 50%, meaning that the same asset would attract a much lower inheritance tax rate of 20%. So not as good as the full relief that you'd get, but nowhere near as bad as feared. Similarly, there were concerns that capital gains tax would also be increased, some speculation that it would match the level of income tax rates, so potentially jumping from 20% to 45% in some cases. This had also contributed to the selling of UK equities, creating further downward pressure on the market. However, these fears also proved overblown. Rates moved from 10% to 18% for basic rate taxpayers and from 20 to 24% for higher rates. Now, this should have a positive outcome for UK equities. Whilst the new rules are less favourable than under the previous regime, it at least provides some certainty to investors and hopefully removes sort of a sword of Damocles that has been hanging over the sector in the past few months.
Absolutely. Thank you for that, Ryan. And moving back to our regular programming, what are the highlights in terms of trust-specific news this month?
Yes, indeed. Moving back to more trust-specific news, the month saw the result of Asia Dragon's strategic review, with a decision made to pursue a combination with its competitor, Invesco Asia. Asia Dragon is one of the largest trusts in the Asia-Pacific sector, but had struggled for performance over the long term. This led to Ashoka Emerging Markets, a much smaller and younger rival, to make a fairly audacious bid for the trust, which led to the board having a strategic review, the outcome of which was to agree a combination with Invesco Asia. The conditions of this combination will allow investors to elect for up to 25% of capital back at a 2% discount to NAV, whilst Invesco Asia said that it will begin offering a tender offer in 2028 and then every 3 years thereafter. The combined vehicle, even if the full 25% is taken up, would lead to assets climbing above £800 million, which would put the trust comfortably in the range for an automatic entry into the FTSE 250. This, in theory, should help with liquidity and potentially put the new trust, which is slated to be called Invesco Asia Dragon, on the radar for more investors. Should also help with sort of the other typical factors of mergers leading to lower costs due to economies of scale and so on. Now, as a bit of a background for those not fully aware, Invesco Asia has more of a contrarian approach, looking for out-of-favour ideas with quality characteristics at attractive valuations. The trust also has an enhanced dividend policy that means it pays around 2% every 6 months, so around 4% a year, and that comes from a combination of the underlying revenue that the portfolio generates, as well as a contribution from capital. The trust began quite an aggressive buyback program in 2024, which is expected to continue post-combination, and the goal of this is to sort of keep the discount in the single digits. We think all of these factors together make the trust a quite compelling option in the Asia-Pacific sector. Moving on from the news, we now turn our attention to results. Joe, you've been looking at the results of the International Biotech Trust, IBT. What were the key highlights from them?
Yeah, it was a strong set of results for IBT, who once again beat the Nasdaq Biotech Index, or the NBI for short, with a NAV total return of 15.9% versus 15.3% for the index for the year ending 31st of August 24. The share price total return was lower at 10.3% due to a widening of the discount during the year. I think it's been particularly pleasing to see a marked recovery in the biotech sector, driven by investor confidence that rates had peaked at the end of last year. The recovery very much started in large caps, it then broadened to SMIDs. As we know, the biotech sector is cyclical, more in terms of the equity sector itself than the underlying fundamentals, and this is really where active management can prove its worth. So as the cycle started to move into what Ashoka termed the equilibrium phase, they'd started to tilt the portfolio towards small and mid caps, which proved a very well-timed allocation. As we know, large cap pharma companies are using acquisitions to plug their substantial revenue gap from patent expiries, and IBT's portfolio continued to benefit from M&A activity, with the acquisition of 2 quoted holdings by Bristol Myers Squibb during the financial year, and that marked 25 acquisitions in the portfolio since 2021, many of which have been at significant premiums. The private equity portfolio, which currently comprises just under 10% of total assets, also had a successful year with 2 acquisitions and an IPO on NASDAQ. In their results webinar, Ashoka mentioned that large cap M&A activity had quietened down a bit ahead of the election. So with a new president as of a few hours ago, they expect normal service to resume on that front. And falling interest rates have also historically been positive for the biotech sector. So I think a promising outlook for biotech trusts such as IBT. And now, Ryan, you've been looking at the full year results for Ashoka India. What did Prashant and the team have to say?
Thanks, Joe. Yes, as you said, AIE had their annual results for the 12-month period to 30th of June published last month. In that time, the trust delivered very strong absolute returns, climbing 35.5% in NAV terms, though this was slightly behind the benchmark of 37.7%, though we would caution that the benchmark doesn't account for CGT in its returns. Now, whilst this period saw slightly weak relative returns, it hasn't affected the long-term performance of the trust, which is still very strong. Since launch in 2018, the trust is up around 187% in NAV terms. That is far in excess of the benchmark, which is up 114%, and the sector average around 63-64%. Now, performance in the period primarily came from stock selection, driven by the manager's preference for small and medium-sized businesses. The White Oak team that manage the trust are highly experienced in the sector and have used this experience to drive performance, with top contributor being Azad Engineering. Other top contributors include private bank ICICI and industrials firm CG Power and Industrial Supplies. The managers remain optimistic for the future of the Indian market too, due to the deep-rooted structural growth drivers the country continues to have, although they did caution there's always a risk that sustained weakness in global growth could weigh on the market. The strong performance did reflect in share price returns, though, with a return of 35.9% for the period of the results. This meant that the trust stood at a premium at the year end. However, they have slipped to quite a rare discount in the period since. The current discount is around 4%, which could arguably be an opportunity for long-term investors.
Thanks, Ryan. And moving on to our final results piece, which are the interim results for BH Macro. What did these reveal?
So these results are for the 6-month period to 30th of June 2024 and show a slight down movement in the NAV, which decreased about 1.1% for the sterling share class and 1.5% for the US dollar share class. However, the period since has been much better. NAV has been up 3.9% over the calendar year to the end of September for the sterling share class and 3.2% for the dollar. The results and the period since are in a way a strong demonstration of the characteristics of BH Macro. Whilst in the beginning of the year, the approach of offering highly diversifying returns was a slight drag to performance, as the market was following a more of the same approach and being driven by positive momentum. Whereas in the period since, we've seen some volatility, especially in the early August, where indices like the S&P 500 fell by about 6%, the Nikkei fell by about 10%. In that period, BH Macro's dollar share class was up around 2.2%. So we think this really demonstrates the portfolio diversification benefits of the trust. In the results, the board announced that they had continued with the share buyback program, and this is carried on in the period since. This is only in the sterling share class. Since the end of the period, these buybacks have totaled over 1% of the shares in issue, but despite this, the trust remains at a fairly wide discount of about 7%. With BH Macro being one of the few ways of accessing one of the country's most prolific hedge fund strategies and its track record of performing well in challenging times, it could be a compelling option with the potential of performing during diverging outcomes in developed markets with some of the news we've got coming out and on the horizon.
And just to mention, we hosted a live teaching session on hedge funds today with a particular focus on BH Macro. So if you weren't able to attend the webinar, there's a recording on the KTI website alongside a guide to investing in hedge funds.
Thank you, Joe. Last month marked the third instalment of our new monthly column, looking at the 10 most bought and sold shares and trusts by UK investors in the past month. What trusts were currying favour with investors in October?
Yeah, so before we get into the highlights, our Top of the Stocks article has the full details of the most and least popular investments, so head over to the KTI website if you'd like to find out the full details. Starting off with a slightly perfunctory aside on the most bought shares front, once again UK blue chips dominated buy lists in October, with Lloyds taking top position. But it was interesting to see that investor appetite for income-paying shares was also reflected in the most bought trust lists. JP Morgan Global Growth and Income, JGGI, made it 3 months in a row and was joined by debutante City of London. City is the largest trust in the UK equity income sector and has earned the accolade of the longest track record of dividend increases amongst the AIC dividend heroes, with 58 consecutive years of increases. It's also outperformed its benchmark over 1, 3, 5 and 10 years, so you can see why that one is popular with investors. But perhaps most notably, Greencoat UK Wind entered our top 5 table for the first time and knocked Scottish Mortgage off top spot. Greencoat, by way of brief background, aims to provide an RPI-linked dividend and is currently trading at a dividend yield of more than 7%. However, I think it's a 16% discount that seems to have been catching the eye of investors, with the infrastructure sector falling out of favour during the rate hiking cycle. Greencoat's discount travail started in mid-2022 when gilt yields spiked, but discounts could narrow as we start to enter a rate cutting cycle. And on that very topic, we just published a research note on Greencoat if you'd like to read more.
Thank you, Joe. Now, we also launched our Market Matters podcast last month, where we bring listeners big picture insights from leading investment specialists. You sat down with Charlotte Cuthbertson, manager of the MIGO Opportunities Trust. What did Charlotte have to say on the podcast?
Yeah, MIGO invests in discounted investment trusts, so it was interesting to hear Charlotte's views on avoiding value traps in terms of discounts, but also identifying the necessary catalyst for discounts to narrow, whether that's a wind-up, a takeout, the underlying portfolio coming back into fashion, or a push in terms of marketing to investors. Amongst other things, I asked Charlotte what has surprised her the most about stock markets this year, and she felt it was markets remaining surprisingly upbeat despite sticker inflation, higher for longer rates and geopolitical risk. And that topic naturally led on to the concentration of the Magnificent Seven, which I know we've discussed already in previous podcasts. But Charlotte spoke about lofty valuations pretty much pricing for perfection, so there is potential downside risk if earnings disappoint. In terms of the AI boom, her view is that we're probably overestimating it in the short term and perhaps underestimating its impact over the next 10 years. But indeed, how difficult it is for active managers with US exposure to outperform without holding the Magnificent Seven. Finally, given the popularity of low-cost ETFs, I asked Charlotte why investors should consider investment trusts. So we discussed the opportunity of investing in less liquid asset classes, particularly in the small cap arena, as well as more specialist areas outside mainstream markets, which could complement passive funds with a US tilt. In terms of sectors, she mentioned healthy yields in areas such as infrastructure and renewables, and also opportunities in the private equity sector at the moment. If you'd like to listen to the full podcast, it's available on YouTube, Spotify and Apple Podcasts.
Thank you for that, Joe. And now I'd like to bring in our guest speaker for this month, our colleague David Brenchley. He hosted a couple of interesting podcasts recently. David, what highlights do you have from us?
Yes, I think the first one that I would highlight is BBH, Bellevue Healthcare. Had a really interesting chat with Paul Major, their co-portfolio manager. Now, I think BBH is a really interesting trust. And speaking to Paul and Bray, these two guys are real kind of experts in their field, in healthcare investing for, 2 decades at least. Their university degrees were all in healthcare, so they have a real kind of great knowledge. And they were kind of talking about these weight loss drugs, GLP-1s, which obviously we've seen, a lot of kind of appetite for them and for the companies that produce them, Novo Nordisk, the Danish company, and Eli Lilly. So they gave us a real interesting kind of background on, how long these have been in development. I didn't realize just how long they've kind of, been in the pipeline, I guess. And now we're kind of, reaping the rewards of that. But interestingly, they actually don't invest in either Novo or Eli Lilly on valuation grounds. They do have some exposure to the kind of obesity side of things, but they're looking for, I guess, the next leg of the weight loss drug story, where it goes from here and, what else they can kind of harness in terms of, attractive valuations within the sector. And the other one, BBGI, Global Infrastructure. Infrastructure, I think, is in a really interesting kind of phase now. It had been hit by rising interest rates. Shares haven't done as well, but these are investment companies that were trading on double-digit premiums not too long ago. They're now on double-digit discounts. BBGI less so. So its discount is much narrower because it has a lot of differentiating kind of things that's completely global. It isn't just UK focused. It's got a very good balance sheet. The management is kind of really aligned with shareholders in terms of it's actually internally managed. Very few investment trusts are internally managed. All the employers have skin in the game. They all own shares in BBGI. And it's definitely a really interesting crossroads. The discount is much narrower, but, hopefully that's a good thing. It shows it's kind of doing a good job, I think.
And thanks to David for joining us today. And finally, Ryan, we had the final presentation from our global equities event from Blackrock Latin America. What did manager Sam Vecht have to say?
Yes, Sam concluded our event focused on global equities in a year of change with a run through his Latin America trust. He highlighted how the continent is very dispersed and that could be quite considerable volatility, with large proportions of companies in the index moving by over 40% each year. But this provides significant opportunities for active managers. As such, he highlighted how important it is to have a strong research resource, which they do at Blackrock. This research is supported by significant travel by the manager himself, looking for many opportunities across the region, including visits to countries like Guyana, which was actually last year's best performing economy globally, well as visits to Mexico and the Caribbean. That said, the vast majority of opportunities Sam has identified are in Brazil due to attractive valuations in the market and better economic performance. He also sees lots of opportunities in Mexico following a post-election sell-off. Plus, he believes the country could benefit from the effects of nearshoring of supply chains. These allocations have led to Brazil and Mexico dominating the portfolio as they do the benchmark. Sam also discussed his sector positioning, which reflected where he believes the best opportunities lie, such as primarily in the consumer discretionary space, as consumers are doing quite a bit better than expectations, and this should help drive company revenues. Sam also discussed his overweight to the industrial sector, which he believes could benefit from an increase in the region's exports. But in contrast, the trust is underweight utilities, which he believes offer sort of low beta exposure to the market with limited upside potential. Looking forward, Sam identifies the potential for rate cuts in many areas of the region. This could be supportive for markets. We are soon to publish an update on the region from the trust. So for investors who wish to find out more about the only investment trust focused on the Latin America region, please head to our website.
And that's it for this month's bumper edition on Investment Trust News. If you'd like to find out more on any of the topics we've covered today, please head over to the Kepler Trust Intelligence website, and we hope you join us again soon.
Past performance is not a reliable indicator of future results. The value of investments can fall as well as rise, and you may get back less than you invested when you decide to sell your investments. It is strongly recommended that if you are a private investor, independent financial advice should be taken before making any investment or financial decision. Please be aware that there can be a time lag when we release podcasts, meaning time-sensitive information may no longer be accurate at the time of publication. Kepler Partners LLP has a relationship with some of the companies covered in this podcast, which may impair its objectivity. Kepler Partners LLP is authorized and regulated by the Financial Conduct Authority.